Corp reasonable compensation. The rule almost everyone explains wrong. If you own an S corporation and you work in it, you have to pay yourself a wage before you take distributions. That wage is what the IRS calls reasonable compensation. Here is the first thing to know. There is no percentage rule. None. You have probably heard of the 60-40 rule. 60% salary, 40% distribution. It does not exist. IRS Fact Sheet 2008-25 says it plainly. There are no specific guidelines for reasonable compensation in the code or the regulations. What exists instead is a 9-factor test. Training and experience, duties and responsibilities, time and effort, dividend history, payments to non-shareholder employees, bonus practice, what comparable businesses pay, compensation agreements, and whether you used a defensible formula. Notice the fifth one, payments to non-shareholder employees. An examiner can check that from your own records. If your staff earns more than you do, that is very hard to explain. Now the math everyone gets wrong. People describe this election as saving 15.3% on every dollar you take as a distribution. That is only true below the Social Security wage base. For 2026, that base is $184,500. Above it, the Social Security portion stops. Only Medicare continues. The marginal cost of the next dollar of wage falls to 2.9% and then to 3.8% once additional Medicare tax begins. So for a higher earning owner, the payroll argument is much smaller than the headlines suggest. And here is the part that reverses the usual advice entirely. The Section 199A deduction is capped at 50% of your W-2 wages. If your wage is too low, that cap binds, and it can cost you more than the payroll tax you avoided. Consider a hypothetical. A non-service business producing $800,000 before owner pay. A single filer above the phase-in range. At a $100,000 wage, 20% of qualified business income would be $138,000. But 50% of wages is only $50,000. The cap wins. Raise the wage to $250,000 and the allowable deduction becomes about $107,000. In that illustration, the higher wage comes out ahead by roughly $4,600 after the extra payroll tax. The wage that minimizes payroll tax is not the wage that minimizes total tax. Whether that applies to you depends on your filing status, your taxable income, and whether your business is a service business. It is a modeling question, not a rule of thumb. One more thing. Document the number before you set it, not after. In Watson versus United States, the Eighth Circuit upheld treating distributions as wages for an accountant paid $24,000 while taking about $200,000 in distributions. The court noted there were no documents reflecting the salary discussions. A market comparison prepared in advance costs very little. Reconstructing one after a notice arrives is much harder. If your profit has grown and your wage has not been revisited, that is worth a conversation. Tax Expert Today, Naples, Florida, serving clients in all 50 states.